Okay, hello and welcome. This is an OCR F585 video on monetary policy. This is obviously the A2 version of monetary policy. I did do an AS video, monetary policy, as with fiscal, so please do check that out, if you don't get what I'm going on about. But for the benefit of those that can't be bothered, I'm going to give a bit of a recap of monetary policy. Now, not too much because obviously there is a video on that and I don't want to, as before, add another 40 minutes to this. Okay, so pretty much monetary policy is looking at the interest rate, which obviously therefore leads to the exchange rate and the money supply, or something that I went on to discuss in the other video called quantitative easing. So the two components of monetary policy are the money supply and the interest rate, which leads on to have an effect on the exchange rate due to hot flows of money, which is actually something we're going to be discussing in this video, funnily enough. So please do check my video for quantitative easing out if you don't know what that means. But really, it's just increasing the supply of money, which leads to an increased aggregate demand. Okay, that's the short version of it. Anyway, you might be wondering what the hell have I drawn on the board here? It looks like a lot of weird boxes with a couple of arrows in between, with terms that are fairly familiar. Well, something called the monetary transmission mechanism. Now, that's a hell of a fancy word for just saying how the interest rate affects the economy. Okay, so I'll just talk you through the structure of this. So we've got the interest rate, and obviously if we increase or decrease it, it goes through each of these pathways. So let's pick the market interest rate. So if we pick the first one, so we see how that affects the market interest rate, and then how the market interest rate has an effect on domestic demand, net external demand, aggregate demand, demand pull inflation, and CPI. So we all follow the same path, okay? But we just start by discussing different things. Okay, so that first one, let's go through there. Okay, so market interest rate. So if we increase the rate of interest, the market interest rate increases as well. It's basically saying the same thing, pretty much that. If the market interest rate increases, then domestic demand will decrease. Domestic demand being C plus I plus G, sorry. Should have probably written that. Okay, so it's C plus I plus G, okay. Okay, and obviously that decreases. And net external demand, well, because our interest rate increases, we see a decrease. We see our exports become more expensive, okay, because the interest rate leads to an increase in the exchange rate, which decreases net external demand. Therefore, you could say it depends on the magnitude of each effect what aggregate demand would have. Therefore, demand pull inflation. Therefore, CPI. Okay, so asset prices. Let's go for that one. As I said, I think the method for these kind of follows the same kind of pattern. Okay, so the increase in the interest rate leads to an a decrease in asset prices, because an asset price is generally kind of a house. You think of it like that. Okay, and if the rate of interest increases, most people don't have £250,000 or whatever your house costs just lying around. Okay, and therefore, if people aren't going to demand it because the interest rate is increased, people on a variable rate mortgage, remember that. But even though there's a fixed rate mortgage, if the mortgage rate increases, the fixed one will increase if people have just bought it then. Okay, if that makes some kind of sense. But it's not in line with the increase in the rate of interest. Okay, so the asset prices therefore will decrease as people aren't demanding as much because it's more expensive to buy mortgages. And if it's more expensive to buy mortgages, people are, therefore, because consumer spending is part of mortgage, okay, that makes it up. So therefore, domestic demand decreases. Net external demand, which doesn't really have an effect on that part the one we discussed before. So both of these decrease in the end. So we decrease aggregate demand, decrease demand pull inflation, decrease the consumer price index, which is just the measure of demand pull inflation. Okay, and then interest rates. So if we increase that, business and consumer confidence, well, it's going to be for businesses. Let's start with that. It's going to be more costly because the rate of interest is also known as the cost of borrowing. So if the rate of interest increases, therefore we also see an increase in the cost of borrowing, loans, etc., as with houses. Okay, and consumers, same kind of thing for asset prices, where they don't feel as confident in buying stuff, so therefore the confidence decreases. Therefore, the investment and consumer expenditure decreases, and therefore, as before, net external demand decreased, so aggregate demand decreased, so therefore demand pull inflation decreased. let's look at the value of the exchange rate. Okay, so if the interest rate increase, we said in the UK, therefore there's going to be hot flows of money because not only is the interest rate, remember, it's not only a cost of borrowing, it's also the amount you get back for putting it in the bank, which is always quite nice to have a bit of extra cash. Okay, so anyway, the value of the exchange rate increases, so therefore, sorry, the interest rate increases, so therefore the value of the exchange rate increases, and if the value of the exchange rate increases, well, we related to net external demand, our exports are going to be more expensive, but our pound's going to be stronger, so imports are going to be cheaper, so then therefore net external demand decreases. Domestic demand, obviously, decreases as well, because people are buying less domestic stuff, so that also decreases aggregate demand. Input prices, well, obviously they decrease, which these are decreasing the CPI. Okay, so obviously all of that is reversed for a decrease in the interest rate, but really all of this diagram, all of it's showing is the effect on the economy through a change in interest rate. Okay, that's really, I mean, hopefully it's not too dissimilar from how your mind thought through the impact of the interest rate on the economy. That was just more of a showing it in a diagram kind of format, really. Okay, so that's the first little bit of A2 monetary policy. Now, once we've got that out of the way, as I said, the reason I've kind of included that before going over the AS recap is what I forgot. But as I said, it's not too similar to what you did last year. There's nothing new on there. It's just a recap of how it affected it. So the rest of the monetary policies we said, you know, it is influenced by the interest rate, the exchange rates, also the supply of money, and the advantages and disadvantages are just those from looking at the graph. Okay, the interest rate decided by the MPC meet monthly to determine what the level of interest rate should be, and obviously it takes a couple of days to work that out, but it's been 0.5% since 2009. So hopefully that's what you would have remembered from last year, and obviously the diagrams as well. Okay. Alright, so the first thing that we're going to talk about in A2 is that, well, okay, we're going to talk a bit more about that monetary policy committee. Now, obviously, you know it meets monthly, but what we said there's a time lag on the effect from the interest rate. We said when the interest rate changes, it takes a year to affect output and another year to affect prices. And obviously, when it affects output, it affects aggregate demand or GDP. Okay, and when it affects prices, that is known obviously as inflation, changing the general sustained rise in the average price level, which if you increase the rate of interest, that's what's going to happen. So let's attach some numbers to this, okay? So say if we change the rate of interest, or the base rate, by plus or minus 1%, so we just change it by 1% of the interest rate, okay? This is therefore going to affect output, so whichever way you put it, output is going to change by 0.2 to 0.45%. Sorry, 0.2 to 0.35%, okay? And the prices, the inflation, change in inflation, is going to be affected by 0.2 to 0.4%. Okay, so it's very, very marginal. For a whole 1% increase in the interest rate, we're only seeing, you know, small decimals, really, in terms of change of percentage, okay? So that's not 40%, remember that's 0.4%, okay? Don't know why. It's just my crud drawing, really. Okay, so that's how the interest rate, that's the actual numbers that you would put with the time lag. Now, as I said, you weren't told that, probably weren't told that in AS, because you wouldn't have been able to, not you wouldn't be able to understand, you weren't expected to understand that, okay? So we've just really attached some numbers to it. It's just a case of learning them, and if you remember them in the exam, great. Okay, now, we also, interest rates not only affect prices, but as I said, they also affect output. And the only thing we talked about having output was obviously the business or economic cycle, okay? When it did something like that, okay? And the interest rate is used to kind of squash this together. So we move closer to being consistently on the trend line, okay? And really, this is just explained. So obviously, when it's below the trend line, we've got a negative output gap, and when it's above, we've got a positive output gap. And what we want is to be on the trend line, okay? So we manipulate the interest rates to help us with this, okay? So obviously when we're in a slump or something, we'll decrease interest rates, which will get the economy going back to towards a recovery. But when we are on a boom or a peak, obviously, then what we want to do is reduce the investment, etc. So we'll increase the rate of interest, okay? So as I said, hopefully that makes some kind of sense, really. It's just how the interest rate is affected by the economic cycle. Now, obviously, it's the accelerator effect that we looked at when we were doing economic growth, which suggested that an increase in the interest rate is determined by the rate of increase in GDP. Okay, so if you don't get what I mean by that, please do go and check out the economic growth video. Okay, so I've written on the board there that the UK uses a free floating exchange rate, okay? And what that essentially means, as I said, I'll be doing another video for that, but in essence, it means that the UK and the government doesn't purposely intervene with the exchange rate. I mean, obviously, they manipulate the monetary policy to, you know, exert. They're not restricted, okay, in terms of, you know, if they weren't and they were operating a fixed exchange rate in response to another currency, say £1 is always worth $2, for example, then any policy such as the monetary policy that has an impact on the exchange rate, they are kind of limited by what they can do with that policy, because obviously they've got to keep within a fixed limit. But because we have a free floating exchange rate, it doesn't really matter what we do to it, okay? Because we just leave the market forces of demand and supply for the pound to sort of cancel each other out or manipulate it down so we get an overall equilibrium. Okay, now what we're going to talk about now is the interest rate in the UK from around before 2008 and up to 2008 and then sort of past it, okay? So before 2008, I'm talking from sort of 97 onwards really, the UK had an interest rate which was higher than the ECB's, the European Central Bank, and the USA, okay? So pre-2008, the UK's interest rate was higher than the ECB's interest rate, so the European Central Bank's interest rate, and the USA's interest rate. So therefore, the investors in the US and the European Central Bank would buy our currency to save in our banks because we've got a higher rate of return. So obviously that led to, because there's a high demand for our pound and we have a free floating exchange rate, so the government's not going to try and intervene to correct this, okay? We would have a very strong pound, okay? So the pound would be very strong. And this would be because essentially this leads to hot flows of money entering the UK, okay? Hot flows of money. Okay, so that's essentially what happened in 2008. And then 2008, obviously, we hit the recession. As I said, there's a video on that. But to combat, obviously, falling, demand, spending, investment, what essentially happened is they reduced the interest rate, the MPC, to its lowest, 0.5%, okay? And this was in the hope that businesses would see this and take advantage of the lower rates of interest and start investing, and people would not be attracted to spend because obviously the interest rate's lower, they're not going to get a return, so they might as well spend it, okay? And this was all in the hope that it would give a boost to the economy. And because this is so low and you can't really make it much lower, if anything at all, okay, that would make an impact, essentially. We call it an accommodatory, so A-C-O-M-M, accommodatory, sorry, I can't spell, but you get the idea, accommodatory monetary policy. Okay, and what that means is, it's just with the expectation that it will boost aggregate demand and consumer spending. Okay, but I mean, we're in terms of a recession here, and going back to what a recession actually was people being defaulting on their mortgage payments, okay, these subprime markets. And if people are in debt, it doesn't matter if it's a lot cheaper to spend than one before, any money they get will be straight put back into paying off this debt, surely. I mean, obviously, as well as living the essentials. But any extra income, they'll just be trying to pay off this debt as quickly as they possibly can. Now, if we start lowering interest rate, it doesn't mean they're going to spend or invest, because obviously if no one's spending, there's no demand for labour, there's no point in investing in capital to make that labour more efficient, surely. So what is the point of lowering the rate of interest? Okay, so that was one of the theories that came up from that. Some economists argue. I mean, obviously it does promote, cheaper investment, cheaper borrowing. So obviously businesses are more likely to invest, but you have to think about the outside, the external effects on the economy. So the current situation of it obviously wasn't very good. But back in the 1930s, there was a similar situation. Obviously, the cause of the recession wasn't the same in the 1930s. But in the 1930s, what essentially we had was, the Wall Street crash of 1929, which is for a history video. But essentially, that meant people weren't spending, they weren't confident in being able to spend. And in that time, there was obviously an economist called Keynes, and that's why we got our Keynesian long aggregate supply curve, because he came up with that idea in the 1930s, obviously, and it's more favoured in when we're in times of recession, Keynes, but I personally prefer his method anyway. Anyway, how does this relate to it? Well, he came up with this idea called the liquidity trap effect, and it kind of relates to this really low rate of interest, okay? And having such a low rate of interest, okay, and it kind of goes off from the fact that even though we have such a low rate of interest, people aren't going to be spending, people aren't going to be investing, because there's no point in them investing, because they're not going to get much of a rate of return on something. If they invest in a share of a business, for example, to give that business some funds so it can go on to expand and update its product range or whatever it might do with the investment, okay, there's not going to be an investment, because there's such a low rate of interest. This is in really low interest rates, and essentially what would happen there is people are not going to invest, even though investment is interest rates are low. People aren't going to invest because they're not going to get a rate of return, because remember, the interest rate is also the rate of return as well as the cost of borrowing, okay? So essentially that's why Keynesian came up with that idea, because back in the 1930s there was a lot of economists saying, yeah, we should definitely lower interest rates to try and kick-start the economy. And he went on to explain that the multiplier would be a better idea. So please do check out my multiplier video if you don't get what I mean by that. But it's essentially, you put some money in the economy and it goes on, and basically it multiplies itself. A shame, unfortunately that doesn't happen when money's in my pocket. It seems to disappear quite quickly. Not that I've been robbed, but I just spend it. Okay, so that's the liquidity trap effects. Now what we're going to go on to talk about now is just something about the prices, okay, in the economy. I'm not going to write too much about it. There's two types of pricing. Obviously, there's price stability, where we have a general price level. There's no changes in the price level. I mean, there might be a small change, but there's nothing big enough to affect businesses' costs of production. There's nothing that's significant enough to warrant a huge reduction in consumer spending. So obviously that's price stability, whereas price signalling is really just it's obviously the opposite, price stability almost, because is the market's letting the price be dictated by the forces of demand and supply. And obviously if the price reduces, the consumer and businesses know there's something up with demand or supply, and obviously you can work out which one it is, okay? Because if it's not them, it must be the other party. In terms of, if it's not the consumer, it must be the supplier, okay? The supply is too much, okay? So basic demand and supply analysis, really, that's just a little bit on prices, okay? Just rub that off. Okay, so now what we're going to go on to is something called inflation targeting, okay? And yeah, that's right. There's two types of inflation targeting that you need to know about. There's one called symmetrical inflation targeting and asymmetrical inflation targeting. Okay, so just write inflation targeting. And now, obviously, you can guess. It's how it says, really. Okay, so a good way to think about it, if we put some numbers to this, okay, so say we're in symmetrical inflation targeting, okay, that means essentially our rate of inflation, our target would be plus or minus 2%, for example. So either side of the target, we'll call it 3%, there's a 2% margin either way. We can have inflation 2% higher and 3% or 2% less. Okay, there's an evil distribution. Okay, I'm going to speak anymore today, do apologise. There's an even distribution of, the margin on either side of this target, okay? But the asymmetrical target is quite the opposite, okay? It's just something, we'll say, oh well, it's more on one side than the other. And an example could be, X inflation rate is less than 3%, then they're happy, okay? And that's almost something like what the EU did back in a couple of years ago, where they said, inflation is great, as long as you get it below 3%, we don't care what it is. But that's if you think about it, it's a very bad policy to have. Because, well, yeah, we don't want inflation to be high, but we don't want it to be too low. We want it to be just right. It's the Goldilocks story. I think that's the actual method. But behind the bedtime story of Goldilocks, it's not about porridge. Don't get confused. It's about interest rates. You don't want them too high. You don't want them too hot. You don't want them too cold. You don't want them too low. You want them just right. Okay, so obviously I've just ruined your childhood for you. I'm deeply sorry, but that's life. We get on, live with it, and die and do economics. Anyway, so really the symmetrical and asymmetrical target is, as you can see, well, essentially if we had negative inflation, it'd be the economy's contracting, maybe because of a reduction in demand pull inflation that was really excessive, okay? And obviously that would cause major complications, but according to an asymmetrical target, that's still fine. But obviously if you were to do that with a symmetrical target, that wouldn't be so fine, okay? So just an example. But what really we need to understand with this is, obviously we've got advantages and disadvantages with it, okay? Because it's not all good having an inflation target, and some of these will just apply to both of them, just having a target, and some of them will, advantages and disadvantages will apply to a specific, so an advantage could apply just specifically to symmetrical, so over having an asymmetrical target. Okay, but the first one is sort of a both really, although you could say it applies more to symmetrical, because it's more of a tighter target, it's more of a confined target, okay, and really it's just in monetary policy being able to have more of a direction, being set guidelines, so to speak, okay, because obviously the monetary policy interest rates, obviously that affects prices at some stage. And the monetary policy, we could, if the so I just put flexibility under it. Okay, so if we've got guidelines of prices, then obviously there's only so much we can do with the monetary policy. If we still want to keep prices within a certain target, for example, the symmetrical target plus or minus 2%, which is just an example, by the way. Okay, so that enables the governments to keep in line of what they're doing. And I put flexibility under there because it kind of goes on from the being set guidelines. The flexibility just says, well, we know how much we can increase it by, and we know how much we can decrease it by, so the margin of what we can change is very easy to just go with, okay? And obviously the margin between that you can decide, well, what specific point do you want it, okay, inflation. Alright, another one is probably one that you might have thought of. It's expectations, okay? Now, as I said, it's not really related to any policy, but if you'd say to the economy, right, well, just get the economy in a line and go, right, economy, you're going to keep inflation between plus or minus 2% of our target, okay? Or less than 3%, just an example, okay? If people expect the inflation rate to be at a certain point, then it will act in a way that causes that. So it's kind of similar to the idea we had about the exchange rate, when we said, people expect the exchange rate to be high, they'll demand more of the pound, so they'll actually cause it to be a lot higher. Obviously, we're not talking about the exchange rate here, we're talking about inflation, but if people expect prices to be higher in the future because of inflation, then they will buy now, so they will increase inflation. Now, that's just a generalistic kind of idea of how we get to the answer. But really that kind of applies, it's the same kind of principles back, doing the pound sort of thing. Doing the pound, so that's weird. Anyway, okay, so there are two advantages. You don't need to know too many. Because as I said, it's not going to be a really big question on the exam. It might be in the data response. No, not data response. I'm going to know about. Mine's in F585 mode. I do apologise. Okay. However, obviously there's some negatives to this, and some people say in the short run, having a target actually leads to a decrease in short run economic growth. And I guess you could apply that more to the asymmetrical target, because if you say, well, yes, we want inflation to be less than 3%. If you have it less than 0%, which is obviously quite bad, then the economy will actually be contracting. You'll have negative short-run economic growth, a decrease in aggregate demand, essentially, is what this is saying. Okay, because obviously we know short-run economic growth is caused by aggregate demand, so a decrease in short-run economic growth should therefore be caused by a decrease in aggregate demand. Okay, so that's really one of the disadvantages. Another disadvantage is the time lag. Now, we talked about monetary policy being a preemptive policy. Okay, and if monetary policy is a preemptive policy, obviously we said it takes a year to impact an output of for 1% to act between 0.2 and 0.35%, and 2 years to act on prices, which can change for every 1% between 0.2 and 0.4%. Okay, the change in 1% being the change in the interest rate. Okay, so anything can happen. There's nothing to say something can't happen in between the year or 2 years that in between you setting the interest rate and something else happening. Obviously no one predicted the stock market crash in the late 1920s, early 1930s, and no one really predicted the Great Recession of 2008. I would call it great because it's quite effective. You're still probably feeling the effects of it now. Okay, so really that's all that we're going to talk about for monetary policy. Okay, so anything else that you didn't get about monetary policy, you think is part of it, it'll be in the F582 example, so please do check that out on my F582 playlist. If it's not up yet, I do apologise, I should have put it up last year, but I just have this dreadful feeling that I haven't put the policy videos up. So I'm saying, oh, check this video out, it doesn't actually exist, but it should do before the exam. But if you have any queries at all, before if I don't get to put the video up, please do comment on this video. But as I said, the main thing you need to talk about monetary policy is it being, a demand management policy. But we can also mention it as actually being a supply side policy as well. Because if we lower the rate of interest, which is a component of monetary policy, obviously, that encourages investment. And as we know, investment is the purchase of better quality capital or increase in the stock of capital, which also means that our quality and quantity of factors of production are both increasing, which obviously leads to long run economic growth. Okay, so that's how you can, so all policies can affect supply. You get supply side policy, which we're going to go into in the next video, obviously. Well, I say next video, I'll say that's just how I'm doing it. You're just going to have to deal with that. I'm sorry, but that's just life for you. And the fiscal policy is also impacting on supply. You can also, all of them can impact on supply. So if you get nervous, you can also call them supply side policy. It doesn't matter. Apart from the fact you'll probably, die a horrible, slow, painful, torturing death. But we're all going to come to that at some point anyway. So something cheery to look forward to. This video doesn't seem so bad now, does it? Anyway, thanks for watching, and we'll see you in the next video.